Let's go over some of the consequences of inflation. Inflation leads to a decrease in the purchasing power of money. Recall that inflation refers to an increase in the price level across the economy. If the price level increases by 3%, then it will cost 3% more dollars to purchase the same amount of goods. $1 can be exchanged for fewer goods than before. This impacts almost everything in the economy. For example, say a worker makes $100 per day of work, and inflation over 1 year is 4%. That worker's wages needs to increase by 4% to $104 per day in order for the purchasing power of that worker's pay to remain the same. If the worker's wage doesn't change, or if it increases by less than 4%, then the worker's real income will have fallen. We're first going to cover problems that result from unanticipated inflation, that is, inflation that people aren't able to precisely predict or plan for. One consequence of unanticipated inflation is redistribution of income or wealth. A lot of long-term financial arrangements are made in terms of fixed dollar amounts or fixed interest rates. For example, many mortgages use fixed interest rates. The terms of contracts like these are based on expectations of the purchasing power of money. If actual inflation over the course of such a contract is greater than anticipated, then lenders are hurt, since the purchasing power of money they are paid back by borrowers is lower than they expected it to be, and borrowers are helped since the purchasing power of the amount they pay is lower than they expected it would be when they entered into the arrangement. Some arrangements, like pensions and annuities, specify a dollar amount to be paid to an individual. If the actual rate of inflation is higher than anticipated, then the people receiving those payments, usually retirees, are hurt, since the purchasing power of the money they receive will be lower than they expected and planned for. When inflation cannot be reliably predicted, it creates uncertainty. This is particularly true when inflation rates are high, since higher inflation rates also tend to be more variable. When firms and consumers are uncertain about the prices and economic climate they may face in the future, they may delay expenditures. In particular, firms may act on shorter-term planning and delay major investment. If everyone knew that the inflation rate for the next 10 years would be 4% every year, then workers would demand that wages at the same level of work increase by 4% every year, and firms would be willing to increase wages by 4% every year, since firms would know that the prices they receive for their goods and services would increase by 4% each year. Lenders would recognize that the purchasing power of money will be lower when they are paid back in the future, and would consequently charge higher nominal interest rates for loans. Borrowers will recognize the same thing and be willing to pay the higher nominal interest rates. However, even anticipated inflation causes some problems. Even when inflation is perfectly anticipated, some redistribution of income will occur, since different prices and wages may adjust at different speeds. When a firm changes the prices it charges for its goods and services, it costs the firm time and resources to make and list those changes. These costs incurred by firms changing prices are called menu costs. The term originates from restaurants making new menus when they change their prices. At higher rates of inflation, firms generally need to change their prices more frequently, resulting in greater menu costs. Next, when inflation is high, in order to avoid as much as possible of a decrease in the purchasing power of their holdings from inflation, firms and individuals will put a greater effort into keeping as much of their holdings as they can in forms other than cash or low-interest bank accounts. These forms tend to be less liquid than cash or basic checking accounts, and as a result, firms and individuals must spend more time and resources transferring wealth between different forms of holdings. As a consequence of menu costs, the cost of wealth management, and the uncertainty associated with inflation can slow long-term economic growth. Inflation causes some resources that would otherwise be used for production to be diverted to other activities. In addition, the uncertainty created by the prospect of unexpected inflation can lead to reduced investment, which will slow economic growth.